Welcome to the Investor Success Podcast. Today, I am Jim Ingersoll. We created this show for real estate entrepreneurs looking to grow their investing businesses and really create long-term cash flow and equity the right way. And that ties right into our show today that you're going to love. I created this podcast to help motivate and inspire real estate investors to invest the right way. And when you do that, you get to enjoy many of the benefits of being an entrepreneur focusing on creating great deals. And today we're going to talk about ways that you can keep more of your profit. We have an outstanding show for you today with a great friend who is truly an absolute giver. Marry Hart, welcome to the Investor Success Podcast today.
Thank you, Jim, and thanks for the invitation. I'm happy to be here.
Our success listeners are going to love this today, Marry, because we got a really great topic. But for those of you that don't know Marry yet, you're going to want to get to know her. And let me tell you a little bit about her. Marry Hart is an attorney. She's also the founder of the Hart Law Group based out of Asheville, North Carolina. And now for over 25 years, she's represented a broad base of clients in a variety of matters, from estate planning, wills, trusts, estate and gift tax planning, long-term care and Medicaid planning, trust and estate administration and litigation, guardianship, income taxation, self-directed IRAs, which is one of our personal favorite topics, commercial and residential real estate law. That includes 1031 exchanges, transactional closings, lease contract negotiations, construction law, and business law. She's also the owner of the Carolina 1031 Exchange LLC, which serves as a qualified intermediary and exchange accommodation title holder for Section 1031 like-kind tax-deferred exchanges. And that's exactly what we're going to talk about. And if all of that isn't enough, that she's smart enough to be a lawyer, a great investor who's got some personal investments and things like that. She's also licensed, of course, as a real estate broker, and she's actively investing and nationally renowned educating. I love learning from Marry Hart. She's really contributed to me in so many great ways, and really been a benefit to have her as a really great friend. Marry, let me say it was nice to spend time with you last week at our Investor Success Mastermind in Indiana. So we really appreciate your participating with us down there.
Oh, absolutely. It was a great couple days. I appreciated the invitation there as well.
So a lot of investors this year are having the best investing year of their life. And some of them are enjoying the benefits of selling real estate. But one of the things they hate about the idea of selling real estate is the impact of taxes. Can you help us understand what happens when you pay taxes and the impact that has with compound interest and stuff that you give back a little bit?
Sure. One of the examples I give a lot when I'm teaching is the example of the magic penny, I call it. And I know you've seen this example, Jim, but I'll say it again.
Love it.
If you took a penny and you doubled it every day for 30 days in a tax-free environment, at the end of that 30 days, you'd have like $5.6 million. Now, I didn't believe that till I did the math myself, but it really works. So if you're doing this in a self-directed IRA and your penny was doubling every day, at the end of 30 days, you'd end up with $5.6 million. If, however,
that's pretty good,
magic,
isn't it?
Oh my gosh, it's kind of amazing. It's really hard to believe. But that's the beauty of compounding, right? It's an amazing force in the universe. But the opposite of that is the destructive force of taxation. So if you took that same magic penny and it was subject to 28% taxes as it was compounding, then instead of having 5.6 something million at the end of 30 days, you'd only have 68,000 or 67,000 or something like that. I don't have the math in front of me, but that's what I remember.
I think it is 67 and change.
Yeah. So that 28% tax bracket dropped that from 5.6 plus million down to $67,000. That's the destructive force of taxation. And so as investors, Section 1031 of the Internal Revenue Code is designed to take away the sting of the destructive force of taxation while you're actively investing so that you can continue to upgrade properties without having to pay capital gains taxes along the way. And we can discuss that obviously in greater detail, but that's the purpose behind Section 1031 of the Internal Revenue Code, is to allow people who hold property for investment or for productive use in a trade or business to use the tax code to defer capital gains taxes until sometime in the future and keep your money working instead of having it be reduced by taxes.
So just to recap that, so if you take a penny and you just double it every day, for how long does it take you to get to 5.6 million?
30 days.
I think that should be something you and I need to work on.
I know. Well, if you do it for 31 days, by the way, now it's 10 million. 10 million something.
Right.
So that extra day, we want to do this in the month that has 31 days.
Oh, yeah, you don't want to do it in February, that's for sure. Unless it's leap year, of course.
That's right.
Unless it's leap year. I got to keep that in mind because here's a fun fact you might not know about me, Mary, is that my daughter Carissa was born on leap year, so I'm very much aware of leap years and the calendars in February. Anyways, so double it 30 times and you're up to $5.6 million. But then every time you double, if you pay that 28% taxes at the end of 30 days, instead of $5.6 million, you have $67,000 and change.
Right. Mm-hmm. Quite a difference.
That will get everybody's attention.
Yeah. And I think that, we're so used to paying taxes, and nobody likes to pay them, but we all pay them. But nobody really sits down, I don't think, or most people don't, maybe some engineers like you, Jim, but most people don't sit down and do this calculation of exactly what that difference would be if you could continue this investing for 20 or 30 years tax-free or tax-deferred versus paying taxes as you go along. And we all know that about the time value of money. And the longer you can keep the money in your pocket versus going to the IRS, the bigger you can grow your wealth. And so for those of us in the investing world who are actively attempting to grow our wealth, we want to try to do it as often as possible in a tax-free or tax-deferred manner. And it's Section 1031. It's not tax-free forever necessarily, but it certainly is tax-deferred. And it can make a huge difference in your ability to accumulate wealth.
So let's say somebody has owned some income-producing property for a while, 5, 10, 15 years, and they think this is a good year to cash out because, a lot of people are nervous about what's going to happen with the economy 18 to 24 months from now. So let's say they want to go ahead and take that out. What are the taxes that they would typically pay for a landlord or an LLC that owns some rental property that decides now's a good time to sell?
Sure. So basically you have to start with what the basis of that property is, and that would include a recapture of depreciation, right? So if I bought a property for $100,000 and now it's worth $200,000, then I obviously have the built-in $100,000 in capital gains. But if I've been depreciating my property, let's say I've taken $50,000 in depreciation, and this is a simplified example, well, now my basis is not the $100,000 that I paid for it, but it's only $50,000 because my basis went down by the amount that I've depreciated the property. So now my basis is $50,000. I sell it for $200,000. Now I've got $150,000 worth of capital gains, and that is for most people taxed at 15%. And there is a 20% capital gains tax rate, but it doesn't come into play until pretty high income earners. But if you took $150,000 times 15%, that's $22,500 in capital gains taxes.
Ouch.
If you did, ouch. If you did a 1031 exchange, which probably cost you about $850 in 1031 fees. If you did a 1031 exchange, you could roll that entire $200,000 into the next property. You would not have to pay the $22,500 to the IRS at the time you closed on the sale of your first property, or whenever your tax return is due. Do you see what I mean? So we're deferring $22,500 worth of taxes, and we're able to put that into a new property, and then keep the idea is you keep scaling up and getting bigger and better properties. And one day,
absolutely.
Yeah, one day if you sell the property and you don't invest in something else under a 1031, then you will be recapturing all that depreciation and the capital gains, and you'll be taxed then. But there are a couple of ways that you can make it tax-free forever. One is if you die owning your last property, if you exchanged into a number of properties, and if you die owning that last property, then that property gets a step up in tax basis to what it's worth on the date of your death. So if you leave it to your kids, your family, whomever, they will now get a step up in basis to what it's worth on the day you die. And if they sell it for that same amount, there will be no capital gains. So in that
that's
situation,
pretty cool.
Yeah, it requires death, which is a little bit of a bummer, but, once,
it's inevitable, Mary.
Once you die, death and taxes both inevitable, but we can get rid of the taxes because of death in many cases, at least under current law. The other way is to, let's say you've kept upgrading into more and better properties, and one day you say, I'd like to live in this last property as my personal residence. If you move into the property and you live there long enough, and it is longer than the 2 out of 5 years, it's either 3 years or it's the full 5 years. I can't remember. I have to go look back. But you live in it long enough, then you can sell it and exclude capital gains under Section 121 of the Internal Revenue Code. And that section is the one that says a married couple can exclude up to $500,000 worth of capital gains, and a single person can exclude up to $250,000. So assuming your capital gains is less than those amounts, then you can exclude that capital gain forever if you meet Section 121. So there are a couple of ways to make this tax-free, but in general, the mechanism is tax-deferred.
And that's a great tip that people don't ever talk about. And I know one investor that did that. He took 2 or 3 rental properties, I can't recall how many, and he sold them, and he didn't want to pay the 15-20% taxes. So he took them, and I think can you bundle them? I think he bundled them, and then he bought a personal residence, basically free, and had it free and clear. Yeah,
he would have to, if he did it as a 1031, he could bundle, say, those 3 rental properties, sell them, take the conglomeration of the proceeds, do a 1031 exchange into one bigger, more expensive house, and then if he lived there for the requisite period of time, and as his personal residence, then if he ever sold it, he could exclude capital gains.
So that's a great tip that nobody ever thinks about. And, real estate is powerful like that, Mary. I don't know if you know this, but when I was young, I used to watch my dad was a part-time landlord, and he had like 2 or 3 duplexes and stuff. And what he did is he basically ended up holding them for a while, and then he sold them, and he paid off our family home that we lived in. I mean, it is powerful when you start pulling the gains out of these things to get, and then so you accumulate some debt, and then you get rid of lots of debt. It's really a powerful vehicle, and I love the way that you gave that tip right there. Tell us a little bit about how 1031 exchanges work, because there's everyone thinks they're sort of complicated, and there's so many rules that, it's not really worth it. But the truth is, it isn't that hard once you understand the rules and in the playbook, so to speak.
Yeah, it's not particularly hard, and it's not particularly expensive if you do a straightforward exchange. A lot of people are mistakenly believe that you have to exchange properties, one for the other, literally. Jim, you and I would have to exchange. I'd want your property, you'd want my property, and we exchange those direct properties. You can do that, but you don't have to do that. You can do what's called a deferred exchange, where essentially, let's say that you wanted to do an exchange, Jim, and so you sold your property, but you didn't want mine. So you sold your property, and then you wanted to buy, let's say, Tom Olson's property. You wanted to buy one of his properties, okay?
Yep.
And so if that works, if you find a property you want, then what happens is when you sell your property, you would have entered into an exchange agreement with me as a 1031 qualified intermediary. The proceeds from the sale of the first property would come to me, and they would be put in a trust account, a bank account, basically, an escrow type account for your benefit. And you would have signed some documents and things that I prepared. So at the first closing, you'd sign some documents along with all the other closing documents. Then I get the money, and when you're ready to buy the replacement property, I would send the money to the closing agent for the replacement property. Now, there are some requirements. First of all, to do a 1031, the property that you're selling and the property that you're buying have to be held for investment, so that this does not work for flipping, because that's considered dealer property. It's not considered investment property. But certainly, if it's a single family,
you did mention it could go to personal residence as well.
It cannot be a personal residence. It can eventually turn into a personal residence, but when you buy the next property, and you have to have the intent to hold it as investment property. Okay, so
okay, and that's a good distinction to make. So you may have to rent it out for a period of time before moving
not
into
may.
it.
You will.
You
will have to rent it
Okay.
out. Yes.
And the person that I was referring to earlier, that's exactly what he did. So he took 2 or 3 of these, bought a really nice house, and then what they did, his strategy was he rented it to like I think it was a dentist or somebody like that was young. He rented it. I can't remember what the requirement, Mary, was, but I think he rented it for a year, and then after that he was able to move into it.
Yeah, so well, I shouldn't say, there's a safe harbor basically that if you buy the new property and it stays investment property for 2 years, then the IRS probably isn't going to challenge that. If it's less than 2 years, then it becomes basically an objective or a subjective test, what your subjective intent was at the time you bought the property. And the taxpayer has the burden of proving that it was to be held as an investment property. So if someone does a 1031 exchange and gets a new property, I say paper the file with all the efforts that you did to rent it, not just to sell it because that would be a flip, but, put in your file copies of all your ads on Craigslist, photographs of the for rent sign in the yard, whatever it is. Rent it for, in my personal opinion, I would say at least a year. 2 years is absolutely safe, but at least a year, so that you can pass the straight face test if you get audited by the IRS and you have the proof to say, look, my intent was to hold this as investment, but, a year or 2 down the road, I changed my mind, period, end of story.
I like the way you said paper your file. I like that term.
Oh yeah. Well, I am an attorney. Don't forget. So we believe in killing lots of trees. Paper up everything. We had this conversation at the mastermind, didn't we? And I kept saying, paper it up, paper it up, paper it up. Very important. I sound like a broken record, but it's very, very important, and it can really save your bacon if you have the right evidence in your file. But in any event, so let's say that you have a piece of property that you currently hold for investment. You want to sell it under a 1031 exchange, so you would contact me or somebody like me as a qualified intermediary. We would get certain paperwork prepared and a bank account opened. When you sold your first property, the paperwork would be signed at closing. The money would come to me as the qualified intermediary. Then additional paperwork would be necessary when you bought your replacement property. But in the meantime, from the time you sell that first property, you have 45 days to identify one or more replacement properties or possible replacement properties. And there are some rules with that. So you can identify up to 3 properties without regard to value, okay? If you want to identify more than 3 properties because you don't know which one you're going to close on, one or more you're going to close on, then there are some rules we have to meet, and we can get into that later if you want to. But most people just identify 3 and close on any 1, 2, or 3 of them. So you have 45 days from the time that you sell your first property to file that identification. And really that's just sending me as the qualified intermediary a piece of paper identifying the property. And it has to be specific enough that we know exactly what property it is. So, the address is great, the legal description is great, but we can base it on the address. So once you identify that property, you have a certain period of time in which you have to close on it. And that period of time is 180 days from the day you sold your property. Okay, and so the 45 days to identify is part of the 180 days to close. So the whole thing has to be completed in 180 days from the time you sell your first property. If it's not completed, then it absolutely does not qualify as a 1031 exchange. If you do not identify property within 45 days and close on one or more of those properties, it does not count as a 1031 exchange. These rules are completely black and white. There is no, but. I closed 12 hours later. Nope, too bad, so sad. It's a black and white rule. And a couple other things that are important. However the property that you're selling, however that is titled, whatever name that's in, that's considered the taxpayer. And the deed for the replacement property has to read basically exactly the same. So, and there are a couple of exceptions. But so, Jim, if you and Cheryl held a piece of property in your names, then when you bought the replacement property, it would have to be in your name, okay? The exception to that is if the property is in one person's name only, then it can be the new property can be owned by an LLC of which the single member is that person who was on the deed. So if you own a property in your name, you can buy the replacement property in an LLC of which you are a single member. But if you and Cheryl own the property together, we cannot do a multi-member LLC where you're both members. That will not work.
Interesting.
So, yeah,
and if it's in an LLC, it stays in an LLC. Can you do it in a land trust to a land trust?
Yeah, you can, and not only that,
Okay.
but the land trust, at least in states where a land trust is authorized by statute, that's essentially treated as if it's still in your name. So, Jim, you could sell one property
Gotcha.
and buy the next one in a land trust of which you hold the beneficial interest. And it has to be your standard type land trust where the beneficiary has all the rights to manage everything.
Sure.
The other exception is you can go into a grantor trust. So, Jim, you could own it in your name and then buy it in your revocable trust for estate planning purposes. That's considered a grantor trust, and it is ignored for tax purposes. So the IRS just treats it like it's still in your name. Okay, so we can do that as well. Another thing is, under 1031, property must be like kind. So in real estate, all real property is like kind. As long as it's treated as real property under the laws of the state in which it's located, it's like kind. So whether that's timber rights that are considered real property rights under the laws of some state, or conservation easement, or raw land, or an apartment, or single-family home, anything that's considered real property you can exchange, for some other thing that's considered real property. It's very, very different when you do 1031 exchanges of personal property, and you can do those. Those are for things like rental car fleets, airplanes, construction equipment, the furniture and silverware in a hotel, all that kind of thing. But there are very, very specific categories of personal property, and you have to exchange within that narrow category. For instance, a cow is not the same as a bull. Seriously, there's law that says this. So you cannot do a 1031 exchange and get rid of your cow for a bull. If you have a girl cow, you have to keep a girl cow, and so on and so on. It's really crazy. But and I really rarely, in fact, I've never done a personal property exchange. I've taught about them and I've read about them, but it just doesn't come up very often.
I've never even thought about them. That's amazing.
Yeah. It just rarely comes up. It's usually when people are buying hotels.
I had never even thought of that crazy stuff. But you could do these 1031s if you had a mobile home park, a self-storage, a duplex, multifamily, office.
Well, let's go back for a minute. Mobile homes, it's going to depend on whether or not those mobile homes are deeded. The park, the land itself, yes, of course.
That's
but
what I meant.
The question is, if you own the trailers, are they affixed to the land and considered part of the titled land? Then they can be part of the exchange. If they are not, if they still have DMV titles, then they're considered personal property, and they cannot be part of that exchange. You would have to do a personal property exchange for that. Do you see the difference?
I do. Pretty
the
cool.
other thing that people need to know, you can't exchange stocks or partnership interests or LLC interests or even your beneficial interest in a trust. So, for instance, if I owned an LLC, I couldn't exchange my LLC shares for your LLC shares, for instance. Now, my LLC could exchange the real property that it owned for other real property, but I cannot exchange my shares in my LLC. See the difference?
I do. All right, real quick. So this is an amazing tool that can live. This is like $1 million tool if you're an active real estate investor. And some of the people, some of our success listeners right now are like, I need to get more information and get one of these rolling with Marry right now. So how would they best contact you if they want to consider doing a like-kind 1031 exchange?
Sure. I would just say they could either call or email me at my law firm contact information. And my phone number is, you want me to give my contact information now?
Yeah, for your law firm, not your personal.
Yeah, my law firm phone is 828-271-4278, which spells Hart, by the way. I didn't come up with that. Somebody else did. But it's 828-271-4278. And my email is Marry Hart, all one word, MaryHart, at thehartlawgroup.com. So THEHART law group, thehartlawgroup.com. It's interesting because I've been doing, I've had a 1031 exchange company since, 2003 or so a long time. 12, 13 years. I've never advertised it. I don't have a website. People just know I do it, and I've got 10 or 11 of these going on right now without even marketing it. So, and because I can do it nationwide, you don't have to be licensed in particular states like you do for lawyering. because I can do it nationwide, I'm actually about to rebrand my 1031 company, and it's called Carolina 1031 Exchange right now, but I'm probably going to change the name, and it will be Avalon 1031 Exchange Services, and we'll have a website and all that, but that's not there yet. So, we just never thought it would get big, but people keep calling us, and other attorneys refer to us and everything else. So we're gonna make it easier for people to find us. But right now, they can find me through the law firm.
And this goes back to our mastermind session last week, because we were talking about your branding, positioning, and what you wanted to do and all that. So this is like a result of that, which is wonderful.
Yeah, it's
and I'm excited to see you doing it. Yep.
Yeah, I think it's the right thing. I've been thinking about it for a while, but certainly in the mastermind, everybody's feedback was, yeah, why aren't you doing this nationwide and letting everybody know about it? I'm like, I don't know, guess I ought to do that. So anyway, so we are doing that. I should also tell you there's a couple of other kinds of exchanges I want to make sure people know about.
Right.
The one we've been talking about is just your straightforward deferred exchange. You sell the property you own before you buy a new property, right? How most of us do it. However, there are some circumstances in which either you need to buy a new property before you sell your old one, or the property that you're buying is land that you plan to construct a building on, right? So those are two different types of exchanges. The one is if you have to buy your new property before you sell your old one, that's considered a reverse exchange. You're doing it backwards from what you normally would do. And we can certainly do that type of exchange, but it's a much more complex exchange. I have to go on title to the property. We have to have all sorts of other things, longer documents, more involved things. And so the fees for that type of exchange and the construction exchange are much higher. So my normal fees are usually about $850 to $1,000 depending on the property. A reverse exchange or construction exchange is like $5,000 in fees. It's a much, much different thing. We have to set up an LLC. We've got to do all kinds of, jump through all kinds of hoops. So you can do it, and in certain circumstances, it's worth the extra fees if the capital gains that you're deferring is large enough. But just realize it's not the same thing as your straightforward, easy deferred exchange.
Well, as everybody listening can tell, you are super smart and a true giver, which I love. But tell us a little bit about your event coming up soon, the estate planning event there in Asheville, North Carolina, because that's a great opportunity for people as well.
Sure. I guess, am doing a 2-day estate planning intensive is what we're calling it, and it's geared for real estate investors and professionals and business owners. And we're limiting it to 20 people, and I think we're up to probably 12 or 14 already. So we only have a few spots left. We're doing it outside of Asheville, and we're renting cabins at the Pisgah View Ranch, and you can Google that and look it up. Pisgah's P-I-S-G-A-H, Pisgah View Ranch. And essentially, we're gonna spend 2 solid days getting down into the nitty-gritty of, what we should be doing for basic estate planning, advanced estate planning, probably some asset protection planning. We'll talk about investing with self-directed IRAs, and we're just going to take the time to answer anybody's question, what's on their mind, and really dig deep into topics of interest, starting with estate planning and making sure that everybody's got know what they need to do to get their documents in order. So I decided to do a 2-day event because, you can, if someone wanted to meet with me for 2 days, it would be thousands of dollars, like, I don't know, $7,000-8,000 or something.
Let me tell you, that's a great deal that would be a great deal, and there may be somebody listening that wants to do that because that is a great deal to spend one-on-one time with you.
Yeah, and I do have clients that I spend an entire day with or more, and we're into the multiples of thousands of dollars of time and documents. But this allows people basically to come get some information at a much reduced price. I mean, I've offered a 50% discount to David Phelps's group. I would offer it to your group as well. So for a couple, for 2 people, that is only $647 total plus the lodging and food, which is probably going to be another, I don't know, $500 or something.
Excellent.
I have to figure that out in the next couple of days exactly what the lodging and food costs are. But anyway, it's a very inexpensive way to learn a lot and get your questions answered in a pretty safe, intimate environment with like-minded people.
And
So
that's just
what
something, we talked about it a little bit at our mastermind last week, Mary, but nobody ever plans for what happens after death. And especially as an investor, you got all these assets all over the place. It could be all over the country, and they're all deeded differently. They all have different types of debt, maybe different rental income streams. There's vacation rentals and apartments and, self-storage if you're a Leah and Terry. You know what I mean? There's lots of things, and man, I don't want to leave my kids a mess.
Well, and you've heard me say this before, Jim, but I actually call it your ultimate love letter. Write your ultimate love letter, and that's doing your disability planning and your death planning, for lack of a better word, because, and it doesn't mean you have to be rich. People think estate plan means you have to be rich. No, I did it for my 18-year-old children, as soon as they turned 18. It's the nicest gift you can give your loved ones is to get everything in order. And what I have learned in 26 years of practicing law is, one, none of us think we're ever going to die. We're all immortal. Unless we're with our spouse in the conference room, and then we're all going to die first. And I don't know why that is. We all think we're immortal, but we're going to die first. So go figure. It's a little bit inconsistent. But also I realize that people, they don't know what they don't know, and they assume that everything in the law is very intuitive. If I'm married, everything will just go to my spouse. Well, that's not necessarily the case. And so what we have seen is that there's a lot of things that are not effectuated because people didn't know how things passed at death and the types of documents and things that you had to put in place to make it happen the way you want it to happen. And so I think just being able to dig deep down into those topics and really explaining how all this works and some of the considerations that people need to think about and things that can happen if it's not thought about, I think will be a really good session. I'm looking forward to it very much.
What a great opportunity. And once again, if somebody wants to contact you guys for either your event or your to take advantage of saving lots and lots of money on taxes, what's the best way for them to do it again?
Yeah, that same contact information. So the phone is 828-271-4278, and the email is Marry Hart at thehartlawgroup.com. And I have a website, which is just
heartlawgroup.com. What is your website?
My website is just www.thehartlawgroup.com. And that THE at the beginning is important because otherwise it doesn't get to me.
All right, Mary. All right, off topic a little bit. You and I both love reading books. Of course, your brother's a phenomenal author, but have you read any good books recently that maybe you'd want to share something with our success listeners today?
I've read so many good books. Well, one of my favorites recently within the last year was Darren Hardy's The Compound Effect. I really like that book. It's a great book. And, of course, all the classics, Think and Grow Rich and, How to Win Friends and Influence People. I love the book. I think it's by David Schwartz, maybe, The Magic of Thinking Big. It's one of my favorites. Then I've listened several times to Zig Ziglar. I think is it Zig Ziglar? No, it's not Zig Ziglar. It's Jim Rohn, who does, oh my gosh, he does a great series on.
He's the best.
Yeah, and the name just escaped me, but it's basically about, it's not leading an inspired life, but it's something like that. It's all about.
Make this the best year of your life, or one of those, yeah.
Yeah,
I love Jim Rohn,
Audible,
Darren Hardy was, he became the way he is because of Jim Rohn. It's like a continuation of Jim Rohn, and that's why you mentioned The Compound Effect was a book I absolutely loved, and so many inspiring stories about just taking small incremental steps and continuing down your path and your journey to success. Those are great books. Thank you.
I just looked it up, Jim Rohn. It's The Art of Exceptional Living. And I don't know if you can even get it in book form. I tried to find it and couldn't find it, but I downloaded it on Audible and have listened to it all. It's like I've listened to it all the way through like twice. Like I'm on my third go around. It's amazing. But anyway, those are some of the books that I've really liked in the last year or two.
Yeah, those are all great. All right, Mary, thanks again for being with us today. I really have enjoyed it. And that's it for this special episode of the Investor Success Podcast. also the founder of the Investor Success Mastermind, where we get to hang out with awesome people like Mary, and really growing real estate entrepreneurs working to grow their wholesaling, flipping, and landlording businesses. You can learn more about it at the investorsuccessmastermind.com. And Mary, thanks again for being a great friend and an incredible guest today. I really have appreciated everything on the 1031s and the estate planning.
Absolutely. Thanks again for having me. You know, I love to do this stuff, so
You're
anytime.
truly a giver. All right. Have a great day, Mary. Bye-bye.
Thanks, Jim. You too. Bye-bye.